CVK, over to you.
Thank you, Suraj, and good evening, everyone. Let me begin by wishing all of you a very happy new year. I wish the new year brings a lot of health, happiness, and prosperity to all of you and your loved ones. As we start a new year, my thoughts turn proudly to all the HCLites across the world who continue to take the company higher and farther despite the continuing pandemic. I remain deeply grateful for their dedication, passion, and service. I'm delighted to share that Q3 fiscal 22 has been a spectacular quarter for us with a very strong revenue growth, sustained margin performance, and continued momentum in booking and pipeline, reflecting in our all-round strength in the market. We had another big quarter from a talent perspective. We ramped up significantly and investing in talent training to gear ourselves to address the current and future demand. This has been made possible by the attractiveness of our employee brand in the market and a talent strategy about which I'll speak in more detail a little later. Digital engineering, cloud transformation, application and data modernization continue to remain the win themes in this quarter, positioning us very smartly for the opportunities that continue to open up in these areas. We had great success in our products and platform business with very good renewals as well as growth led by a significant amount of net new license sales. Overall, our growth has been fairly broad-based with momentum across all geographies, business segments, and industry sectors. Now, let me translate these headlines into numbers. Our revenue grew at 7.6% sequentially and 15% year on year in constant currency, which exceeded our expectations. But I always believed it was within our potential to achieve such a spectacular growth. In fact, this was the highest growth rate recorded in the last 47 quarters, and that too on a significantly large base, which is 4 times larger than what it used to be then. This has been made possible through strong growth, both in our services business and our products and platform business. In INR terms, our revenue grew 8.1% sequentially and 15.7% year on year. Our operating margins saw a small increase of 5 basis points, coming in at 19%. We signed 8 net new large services deals and 8 significant deals in the product business across a mix of sectors and segments. We also continue to impress our clients with our capabilities that are very visible and are helping us grow our accounts incrementally through a number of smaller deals. Our net new booking remained very strong at $2.1 billion net new TCV, which is 64% year-on-year increase. When we add this to the renewals we have on an ongoing basis, we foresee good growth over the medium term. We had fabulous client additions across all categories, reflecting a strong broad-based demand and most importantly, the relevance of our offerings. We grew our $50 million clients by 11, our $20 million clients by 13, and $1 million clients by 50 on a year-on-year basis. Our Mode 2 offerings delivered 30% growth year-on-year and 6% sequential growth in constant currency. We also continue to see a strong pipeline, which is reflective of the robust demand environment we are witnessing all around. Now, let me give you a little bit of segmental color to our performance. Our engineering and R&D services led by a strong demand in Industry 4.0, telecom modernization, and digital engineering posted a very strong 8.3% sequential and a 19.7% year-on-year growth in constant currency. To strengthen our engineering and R&D capabilities, we just announced the acquisition of STARSCEMA, a leading provider of data engineering services based in Budapest, in Hungary. I will ask Vijay Guntur to give you more details about this when he takes the stage. Our largest segment, which is our IT and business services, delivered 4.7% growth sequentially, continuing to reflect our leadership in this segment. Cloud remains a very strong catalyst in all the service lines in this segment. Production platform, of course, came back very strongly with a revenue growth of 24.5% sequentially and 8.2% year on year. From a revenue perspective, while all products did very well, we had some great growth in HCL Commerce, HCL DX, which is the digital experience, HCL Unica, which is our marketing automation platform, and security offerings that really stood out in the last quarter. This is a testament to the solid product performance, the product innovation, and the reliability of the support we continuously deliver to our clients and the product stakeholders. Our bold strategy to create a compelling portfolio of software products has resulted in a solid business of close to $1.5 billion today. Today, HCL software is well positioned as a very reliable, client-friendly and innovative software partner of choice, empowering iconic brands and large global corporations to advance their digital transformation journey and add sustainable value to themselves and their clients. In terms of geographic performance, it was led by Europe at 9.1% quarter-on-quarter constant currency growth, followed by Americas at 7.3%, and rest of the world followed it at 4.5% sequential growth. In terms of vertical segments, all our verticals showed high growth momentum, ranging from sequential mid-single digit growth to mid-teens growth rate, led by technology and services, which posted 14% sequential growth. Other verticals that grew in double digits sequentially include retail CPG and telecom and media verticals. All our verticals grew in double digits year on year, with life sciences and healthcare leading the pack with a 21% plus growth on a year on year basis. Coming to the topic on talent, as all of you know, our industry is facing a significant demand supply gap. At HCL, while we continue to onboard experienced domain and tech specialists, our strategy will continue to lean more towards adding net new talent at scale through fresh talent coming out of colleges and schools. Our net addition last quarter was 10,143 people. Helping us on this mission are programs which have deep roots already, because we started on this journey much ahead of the demand cycle. Initiatives like TechBees, New Vistas, our global apprenticeship programs, and scaled upskilling and reskilling programs, along with our employee-focused value proposition, continues to position us strongly for the future. We are on target to achieve 20,000 plus campus hires during this fiscal, having added already more than 15,000 till date. This has been made possible by a robust enablement process created for the campus to company lifecycle and a strong brand that attracts college graduates to build their careers with HCL. As a part of our medium-term campus hiring plans, we also expect to recruit more than 2,000 graduates over the next 2-3 years in the US, which is our largest market. We've also seen an increase of 20% in our New Vistas headcount in India alone, while countries like Vietnam, Sri Lanka, Costa Rica, and Romania continue to expand and scale. In the short term, the attrition numbers across the industry will remain high, but as things settle, clear talent winners will emerge, and I'm confident HCL will come up on the top in this list. In addition to all the recognitions we've received in the global press over the last couple of years as the top 30 global employer, and also as a top-ranked professional services firms globally by Forbes, a report published a few days ago by leading analyst group Avasant and Everest, in fact, have named us as a leader in talent readiness and digital talent capability. So Team HCL, led by our HR organization across the world, continue to do an outstanding job. They've been doing all the heavy lifting over the last several quarters. And last quarter, it was really their peak performance. They delivered outstanding retention of our talent, now additional hiring across the world, freshers, training, onboarding, and doing all this virtually. It's just an amazing job by all our HR colleagues across the world. Now, before I go into the outlook, let me cover another important theme, given the importance of this. Guided by our mission of enabling harmony between people, planet, and prosperity, we as a company have announced a pledge to limit greenhouse gases emission aligned to a 1.5 degrees pathway by 2030 and to reach net zero by 2040. This is our big step forward on contributing towards global efforts on combating climate change, and one that will keep all of you posted on as we progress. I also want to remind you all that HCL was recognized as the leader in Edelweiss ESG scorecard and ratings, and we received the highest overall score among India's top NSE 100 companies. We will strive hard to be a leader and contribute to climate change goal in every possible way. Now, looking ahead, we remain very optimistic about the demand environment, and our diversified and very, very client-relevant propositions and our talent supply capabilities in the long term makes us very, very optimistic about our future. However, I must remind you that Q4 is a seasonally weak quarter for our P&P segment, as the segment performance peaks in Q3 with renewals and new deal signings. Overall, our talent position, pipeline and booking performance, investment trends, and capability mix will continue to give us an edge in the medium term and long term. In terms of pandemic readiness, our global BCP and HR systems remain on standby, and they're well prepared for any escalation of cases across the world. Our employee well-being has been and will continue to remain our topmost priority. Once again, I wish all of you a great year ahead, and I hand it over to PRATEEK, our CFO, to provide more color on the financial performance. Over to you, PRATEEK.
Thank you, CVK. I will quickly go through all the financial details, covering some of the major highlights. To put the current quarter Q3 of FY22 growth overview, services was the biggest part of our business, which grew at 5.3% sequentially. I will remind you it's on the back of 5.2% growth in the last quarter on a quarter-on-quarter basis. So 2 consecutive quarters we've done 5+ growth in our services business. On a year-on-year basis, this quarter versus the last December quarter came in at 16.1% growth in constant currency. The P&P segment is the one which hit a real big sixer. They delivered 24.5% Q-on-Q growth in constant currency, using the seasonal tailwind and recouping the last quarter. Year-on-year growth is 8.2%. Revenue stood at 22,331 crores, and it was up 7.6% for the company, and year-on-year growth was 15% in constant currency. We maintained our profitability at the EBITDA came in at 24.2% and EBIT at 19.1%, both numbers in the Ind AS gap that we published. Profit after tax for the quarter was 3,442 crores, which is at 15.4% of revenue. To cover some of the key metrics, the deal wins came in at $2.1 billion, and 64%, that is a 64% growth year on year. And this is further backed by very strong net hiring, which CVK already mentioned, 10,143 employees. In the last 3 quarters, we have close to 29,000 employees which have been added to the company's roster. Better account mining has resulted into addition of 1 customer sequentially and 11 customers year on year in the 50 million plus category. The effective tax rate for the quarter is around 22.5%. Quick look at the cash generation and cash conversion ratios. During this quarter, the OCF, operating cash flow, came in at $584 million, and a free cash flow of after capex of $521 million during the quarter, which respectively is 128% of net income and 114% of net income. On a last 12-month basis, OCF is at $1.95 billion and free cash flow at $1.7 billion, being 117% and 102% of net income, both very handsome return ratios. Our balance sheet remains strong with gross cash at $2.7 billion. And mind you, this is after significantly higher dividend that we increased last quarter from 6 rupees per share in the previous quarter before that, and we increased it to 10 rupees per share in the previous quarter. So that took out 146 million extra dividend dollars. And we also acquired 19.6%, the remaining balance stake in Action for $100 million. And on top of both these, we also purchased the treasury shares from the secondary market for our RSU plan, which amounted to another $95 million. So all put together, this is 341 million. And despite this 341 million outflows, our gross cash at the end of the quarter is still maintained at $2.7 billion. The last 12 months diluted EPS is at 47.5 rupees per share, which is leaving out the milestone bonus, which is around 2% lower on a year-on-year basis. Dividend declared for this quarter continues at the rupees 10 per share, being the 76th consecutive quarter of dividend payout. Just a couple of quick updates. HCL Stock Option Trust has bought 55 lakh shares through the stock exchanges on 24th of December. This is the $95 million I already spoke about for the purpose of implementation of the RSU plan. HCL is also acquiring 100% stake in a Hungarian company based in Budapest called STARSCEMA, where we are paying about $42.5 million for the acquisition as and when the closing happens, which is expected by March 22. Vijay will go into some more details of that. Handing over to Vijay. Vijay.
Thank you, Prateek. A very happy new year to all of you. I trust all of you are safe and healthy. HCL ERS business has done well last quarter by posting a 8.3% quarter-on-quarter growth, translating to 19.7% year-on-year growth. The 2 quarters prior to also had significant strong growth. I'll talk about what is driving this growth in our engineering business. There are three factors that are driving our growth. One is our digital engineering capabilities and solutions. The second is our investments in 4.0 and solutions there, and the silicon platform services capabilities that we have invested in. All of these capabilities are driving our growth. In particular, our digital engineering capability has been the catalyst for growth. I talk about the segments within our engineering business, which have witnessed strong growth momentum. The first is our software and internet business. Software and internet business is driven by capabilities in AR, VR, XR, which in the future will translate to even higher growth and solution capabilities. The digital engineering capability and silicon platform services capabilities are driving our software and internet growth. The growth in our telecom segment is driven by investments that we made in 5G, particularly O-RAN, and the enterprise 5G capabilities that we have invested in. In the medical devices space, our growth is driven by digital platforms that we have built for data aggregation and analytics on top of it. The trend for providing services across remotely in the digital space, in the medical space, is driving the growth. Our segment, which had softness in a year before, is in the asset-heavy industry segment. That has seen a strong revival led by Industry 4.0 services and IT/OT integration services in that space. Overall, customers are investing in new products and platform development capabilities, and they're relying on partners like us to drive and deliver these platform and capabilities which are business impacting. Procurement in these customers are inclined to consolidation and working with players with strength in this space. I would like to talk about two trends which is impacting the engineering and R&D space. One is ability to transform products into services run on platforms, which the software internet companies are very used to. And we've been working with them over several years to build these capabilities. These capabilities are becoming very relevant to our other industry segments of medical devices, telecom OEMs, and of late, the transportation segment as well. These capabilities that we have built in the software internet space are driving growth for us in other segments in engineering. The second trend that I want to talk about is in the silicon space. Our core silicon design capabilities that we built working with some companies is now relevant to many segments, including telecom OEM, semiconductor, and some of the transportation segments. The differentiation is going back to the hardware and ASIC space, which we are strong and have invested in. The other driver is the shortage of semi-chip across different industries and semiconductor capabilities across industries. So we see a lot of customers of ours investing in fabs across the world. Our semiconductor equipment capabilities are becoming very relevant for these people who are investing across different geographies. In all, the semiconductor space we see will witness strong momentum and growth. CVK talked about our investments in digital capabilities, digital engineering capabilities. Our recent investment in STARSCEMA, which is a Budapest, Hungary-based company, has deep capability in the digital engineering space, especially so in data engineering. And we expect our data engineering capabilities to get further strengthened by this acquisition when it closes later in March. The talent that we have acquired through this investment is going to help us in the front end of large data engineering programs, and we expect synergies to come from there. Finally, the talent capability that's required to serve all our needs for customers in the digital engineering space, silicon platform space, and Industry 4.0 is coming through investment in people by upskilling our people and also investing in new geographies, including Eastern Europe which STARSCEMA will further help us strengthen our presence with. Overall, we are very positive of continuing the momentum that we have built in the engineering and R&D space into the future. Thank you, and over to you, Appa.
Thank you, Vijay. Good evening, everyone. Trust all of you are safe and wish you and your families a safe and healthy 2022. A brief update about our employee well-being, which is at the core of what we do. We almost 90% of our employees are vaccinated, and the current infection levels are low, but we are seeing globally it is increasing. So we are very watchful. We are preparing ourselves in terms of any hospitalizations that may arise. Right now, they are very low. The infections appear to be mild, but we do not know what is in store. So all the support in terms of providing doctor consultations, our hospitalization support, our oxygen concentrators, which we have done really well during wave 2. We have geared up, and we are ready to face the situation if it turns out to be unfavorable. Coming to the most important topic, which is talent. We have been focusing on our talent strategy for the last 4 to 5 years in terms of giving us significant nonlinear results. I mean, we are focusing delivering those results from medium to long term, while tactical interventions are necessary, and we will continue to have them for near-term growth. I will discuss a few of these initiatives as we go forward. From a hygiene perspective, as CVK has mentioned, our net hiring this quarter is around 10,143, which is a 5.41% compared to last quarter. And we have been hiring at that levels for the past 2 quarters, and the machinery is ready. The way the whole talent hiring apparatus processes, we are in a good position to continue the momentum. And we are close to 20,000 in US with a good localization of almost 72%. So one of the talent strategies we have been adopting over the last 5 years is to identify locations where talent is available. I mean, we call our approach as globalization, where we are making significant investments in developing talent in countries like Sri Lanka, Vietnam, Romania, Hungary, Costa Rica, Guatemala, Germany, France, Canada, Taiwan, South Korea, and Brazil. These are in addition to where we have a reasonable scaled operations like Poland, Mexico, and Bulgaria. So we have been investing in these countries to develop a local talent there. As well as you all know, we have 4 locations which we call New Vista locations in India. Similar locations, 9 locations we have developed in US, and where we are scaling up. These are not the primary cities, but very nearby, operating in the same time zone, same geographies, but giving us the scale and cost advantage in those. So we have been developing that. As CVK also mentioned, we are significantly scaling our internship programs and freshers in those areas. And I'll talk a little bit about it when we come to the topic of freshers. In India, also the New Vistas locations, which is for us Lucknow, Madurai, Nagpur, and Vijayawada. We have already scaled up close to 20,000 people there, and we continue to increase this talent. And since all these locations have reasonably reached critical mass for us, it's becoming relatively easier for us to provide career paths and diverse roles to our people, in terms of keeping them where their families are and providing them the rich experience of performing different roles. So it's a strategy which has helped us very well, and we will continue to scale that up even further. In O&D quarter, we have onboarded around 6,617 freshers, which has taken us to 15,787 year to date. But as we speak, we have already crossed 17,500 fresher as of 10th Jan. And we expect to be anywhere between 20,000 to 22,000 of freshers onboarding this year. Needless to say, I mean, our talent strategy has got a big component, which is freshers. And we definitely are looking ambitiously at onboarding double this number next year in FY23. We have done a series of changes. We invested in all the freshers we are recruiting in terms of providing them the compensation visibility for 5 years, point to point. And that gives us, and on-site also, we have recruited close to 1,500 freshers, some of them in terms of intern, some of them train and deploy kind of models. And we are also investing significantly in our talent in terms of providing them the mid-management level. We have given long-term incentives, which is we are covering almost 2.5 times more population than what we did earlier. As Prateek mentioned, as part of that, we are also giving RSUs and to these people. So the idea is to create a stable workforce with a significant retention to all these people. And we have also given higher increments, much higher than what we have given in the earlier years to people. And these increments have come after 9 months. The LTAs also are for a period of 3 years, what we are providing. And I think all these things are helping us as surely the demand supply gap is quite high. Even then, our attrition levels in IT services is 19.77 compared to what we were at 15.7. We see already a bit of flattening of these attrition levels in JFM quarter, but from a LTM basis, it will still go up. But from a year-to-date basis, we see a bit of flattening of this, and hopefully in the next few quarters, attrition probably will stabilize. But very important aspect for us is our junior to senior leadership, which is team leads, project leads, and above. Our attrition is only 12.73%. I mean, this is a cohort which is very committed and stable for us, and in large transformation programs are delivering new tech work. They contribute significantly, and we are very happy with the retention of these people. And we also, as part of our leadership development programs, we also have identified almost 600 people as our next generation leaders who, over the course of next few years, 4 to 5 years, will take up significantly higher roles in the organization. And we are looking at what kind of interventions in terms of coaching, mentoring, and upskilling that needs to be provided for these people to handle those roles as we go forward, so that we have a robust leadership pipeline which can help us in terms of maintaining or increasing the growth levels what we have. And another important aspect of the whole talent strategy is the training. As we all know, there is a huge demand supply gap, and it is not going to be fulfilled by any laterals. So quite a bit of training that has to be provided to our people. Not very long ago, we used to spend 1 million hours per year, but today it is 2.2 million hours per quarter is what we have spent. And this is helping us in terms of improving our internal fulfillment. We have almost 40% of the roles that are coming in, demand that is coming in, we are able to fulfill through various programs like Skills at Scale, identifying the niche skills that are there, training them, certifying them, and then deploying them in the projects that we have. And this program for the last 3 years has helped us to scale up our talent gaps, and we continue to scale this even further into newer geographies as well. Globally, we are scaling this very well. The last part is the gender diversity, which we are at 27.7%, though we are improving, but the improvement is not to our satisfaction. So we are focusing a lot in terms of increasing this. You will see a significant change and increase in these numbers as we go forward. While the leadership layer has increased significantly this year, and but still overall levels we would like to touch cross 30% in the near future. Our diversity is quite high. We have 163 nationalities, people working with HCL. So culturally we are and ethnically we are very diverse. And all the inclusive programs we are running in terms of how do we run this diverse culture and ethnicity people is yielding good results for us in terms of maintaining a very diverse organization. The return to office, we are currently at 3%. So there is absolutely no mandate in terms of asking people to come. Their safety is of primary concern for us. They can along with their managers decide based on customers' requirements and the need for lab access, etc. So we do expect that it is going to be low in the coming quarters, and we are not in a hurry, but definitely we would like to see our people safer. In this quarter also, we have won many awards and accolades from very reputed organizations. For the second consecutive year, we got recognized by Forbes. Organizations like Top Employer Institute, Association for Talent Development have recognized us and given us the awards. So that's the overall brief commentary on HR, and I'll pass on the baton to Suraj for Q&A. Over to you, Suraj.
Thank you, Appa. We will now be opening the floor for questions and answers.
Ladies and gentlemen, if you've joined us from the WebEx mobile app, please tap on the three dots on the floating panel on the bottom of your screen, and then tap on the raise hand option. In case you're on your computer system and want to ask a question, please click on the raise hand icon on the bottom right of your participant panel, and we will unmute your line. And in case you've joined on audio only, please press *3 to raise your hand. Our first question is from the line of Ms. Anisha. Ms. Anisha, please go ahead with your question. Ms. Anisha, your line is unmuted. Please go ahead. She's muted her line. The next question is from Bisma Malik from Business Today. Ms. Bisma, please go ahead.
Good evening, gentlemen. Can you hear me?
Yes.
Yes, we can hear you. Please go ahead.
Go ahead.
We touched upon the various initiatives having been undertaken to retain talent and the kind of crisis the industry is facing right now. But Mr. Rao, we've reported a story yesterday basis some concerns by your former employees regarding the bonus repayment. Repayment, which was basically a policy. Now a specific clause has been revoked, right, under the new policy document. Can you just briefly, touch upon this? That have those concerns been allayed? They were basically, there were unions had approached us saying that they might take this to the courts, the labor court and all, and they have been basically facing some financial crisis as soon as they left HCL Tech. So I just wanted you to, just allay these concerns, which have, brought to our notice. Yeah, that would be it. Thank you.
Okay. Thank you. This topic is on the variable pay, and it has been grossly misrepresented. And this policy, which is a variable pay, has been there for more than a decade in HCL, and it is nothing new. In fact, it was a very positive move from us. The variable pay, which used to get paid at the end of the quarter or end of the year, to help people with more cash flows, we started giving it in an advance monthly manner. So one policy is monthly, we were paying. The other policy, which was annual, also we converted that into monthly payout for people. And this is 5 to 6% of the total variable pay, which is we are on the lower side in the industry also. And this is very clear, right? It has to be. We benefited the employees, but I think it was not understood very well that this is an advance payout of variable pay that we are giving. And hence the policy is very clear that in case they leave in between, they have to pay it back, because this is something which they will otherwise get at the end of the year or end of the quarter. But looking at people who represented to us, saying that they are facing a problem in terms of returning it, they have spent that money. So we actually on our own on 22nd December, we have withdrawn the policy from 22nd December. And the other annual part also we have withdrawn from 1st January. There is absolutely nothing which we are doing afresh now. In fact, it is a benefit that we have given to people which has not been understood very well. So we have given issued a statement, clarification, and any further clarification that is required, you can reach out to the communications team. This has been shared. Whoever has raised this question, this clarification has been shared with those people, and you can get those clarifications also in writing from our communications team. Thank you.
Thank you, Appa. The next question is from the line of Ms. Anisha from ET Now. Anisha, your line is unmuted. Please go ahead with your question. I think she's facing some difficulties. The next question is from Surbhi from Economic Times. Surbhi, please go ahead with your question.
Okay, Happy New Year and to everybody. I just want to understand and get your comments on some bit of what's happening with respect to the demand environment. I believe the sequential growth in constant currency has been the highest in 12 years. So what are the factors which are contributing to that? And going forward, what can we expect in terms of the IT spends coming in 2022?
Surabhi, Happy New Year to you, and thank you for your question. Yes, of course, we posted a sequential growth, which is the best in the last 12 years. I mean, I've been talking about it all along. The demand environment is very robust. Primarily, every company is leveraging technology very intensely to run their business, to thrive and kind of revive their business and also transform their business. I mean, that is translating into many programs. That's one element, which is what is generally called as digital transformation or business model transformation, leveraging technology. The second element is customers are also optimizing their costs across various aspects of their operations, so that they can reinvest in areas which will create a much better business impact for them in the future. So I think these are cost-driven outsourcing opportunities. And the first one that I mentioned is more transformation-driven digital opportunities. So we have a good mix of deals from both. Last 3 quarters, we've announced deal wins. Every quarter, it is much higher than what it was in the previous quarter. Our pipeline is at probably not all-time high, the second peak that we are seeing. It's still a sequential growth of 10%, year-on-year growth of 20%. That's one aspect, which is the market demand and potential that is there. The second aspect is today, a lot depends on an ability to kind of start a project in a timely manner and complete it in a timely manner. I think that's a very important aspect, and a lot of our existing clients are scaling up with us because of our ability to really prioritize and focus on a few customers and really deliver outstanding timelines and the program outcomes. I think that's what is helping us. So this is a differential aspect which we see a lot of our customers talk to us about, which is helping. And then the third element is our business mix. We have a very strong engineering and R&D business. We have a very strong IT and business services led by app and data modernization and cloud transformation. And the third, the most unique aspect is our products and platform business, which is a non-linear business. This quarter, we grew the revenue 25%. Pretty much almost everything flows down into the bottom line after the amortization cost. So I think there are multiple aspects which are inherent to HCL. And then, of course, the demand environment is just outstanding. All of this is what is driving this momentum.
Sure. Thank you so much. Prateek, I had one more question for you. Could you explain the drop in the profits? What were the reasons that have led to that?
So, Survey, there was no drop per se. I mean, it was 19% last quarter. It is 19% right now as well for this quarter. I guess what you are referring to is the drop in the services part of the business. The P&P profit was much higher this quarter versus last quarter, and the services margin was lower. And that is primarily due to the supply side challenges that we are all aware of. It's pretty much an industry level phenomenon. Also, we also had our second phase of salary increments being given out this quarter. That was another 80 basis points kind of an impact for us. And
Right.
thirdly, this quarter is the seasonal is the quarter where there are a lot of leaves, etc., which people take because of the various festivals. There is Christmas break, there is Thanksgiving, Diwali holidays, and all kinds of festivities. So that is another reason why some hit on utilization is there, because people are not available during this quarter.
Prateek, specifically, I wanted to understand the results copy says that the net income has dropped by 13.6% Y on Y in rupee terms, while it's up for 5.4% sequentially. So I wanted to understand that why is there this drop of 13.6% Y on Y?
Right. So, okay, now I get your real question. It's at the net profit level. What I explained was at the EBIT margin level. So net profit, we have also given an asterisk there, which leads to the explanation that I'm about to repeat. It's basically there was a benefit of almost $60 million last December quarter. So that was a very one-timer kind of a benefit which flowed into the net profit because the tax was very low, tax expense was very low for that particular quarter. And when you compare versus that quarter to this quarter on a year-on-year basis, that is what is making it look like that. Otherwise, if you take that benefit out, then you are looking at a drop of smaller magnitude, which is about 4.7%.
So why this drop of 4.7%? What are the reasons for that? Lower utilization and what else?
There are three things that I counted out, and that's in sync with the on a year-on-year basis. If you look at the EBITDA, and the EBIT is also lower by about 3.8% points. So that's the same thing flowing down. And like I said earlier, it's basically 3-4 things. Like number one is the seasonality, the leaves taken by people during this quarter because of the festival season. Second is the increments we gave out this quarter, which is about 80 basis points. And the third is basically the attrition, cost of attrition, and backfilling people at a higher cost, targeted retention costs, higher recruitment costs, and a whole list of things which is summed up in the supply side challenges.
Thank you, Prateek. We have Miss Anisha from ET now. Well, we couldn't unmute her earlier, so she's typed her questions. She has two questions. The first one is, would the growth rate be faster in FY23 given the strong demand outlook, or will the base effect might keep growth limited? Can we expect a 14 to 16% growth?
Yeah. Anisha, thank you for your question. However, it's a little early. You should wait for us till the April results, when we will give you a good commentary of what to expect. But you have all the leading indicators, right? I mean, all the demand environment is very good. The pipeline is extremely robust. Our win rates have been high. Our bookings have been high. So all of this really augurs well for continuing growth momentum. I don't want to call out any specific number, and we would absolutely give you more color on it in the next quarterly results.
Thank you, CVK. The second question is, the number of clients in $50 million has jumped materially. Is there a change in the deal pipeline mix? Any large deals in the pipeline with better pricing?
So I think over the last 12 months, there is a significant ramp up in several of our large customers. So many of them have moved to 50 million plus category. A couple of them are also new wins that we had a year before, which have been implemented and they've ramped up, and they are now 50 million plus clients. There has been pricing increases for certain type of skills and in certain clients in many pockets, but it's still not material to really make a meaningful impact. However, we are working with a lot of our clients to see if we can get an increment, and our customers have reacted quite positively to that request, because everybody understands the current challenge and everyone is looking for very high quality talent, and they're open to consider some rate increases. So right now, I don't have anything more specific to report on that.
Thank you, CVK. Due to paucity of time, we will have to take limited questions. So the next question is from the line of Ms. Shivani Shinde from Business Standard. Ms. Shivani, your line is unmuted. Please go ahead. Yes, we can hear you. Please go ahead.
Great. So good evening, Happy New Year, and congratulations on a great set of numbers. CVK, the question to you is TCV of 2.1 billion, almost 2.1 billion, a great number. But if I look at a quarterly comparison, it's a slight dip. Do you, is it because of seasonality, or are there any other reasons? If you could elaborate a little bit on that. Mr. Guntur, on the recent acquisition that has been done, the R&D, if you could just help us understand the kind of skills that you are getting, also the number of people that you get with this acquisition. March 2022 is what you have said that this will be completed. So, you know, in terms of deals, how is this going to help? If you could elaborate a little bit on it. CVK, coming back to you, just one more additional question. You know, your peers have said day before yesterday that deal sizes are becoming smaller, as in smaller in the sense, even the analyst community are saying the large big bang deals are becoming fewer and fewer. What's been your take on it, and what kind of environment do you see, especially with the TCVs that you've got? That's it. Thank you.
Yeah. Thank you, Shivani, and Happy New Year to you. First, talking about booking, yes, we had a net new win of $2.1 billion. It's a slight decline compared to what it was in the previous quarter. But these bookings are normally best tracked on a year-on-year basis. So when you compare the December quarter in 2020 versus the December quarter that just went by, it's a 64% increase. So it's been a very strong increase in our booking from a year-on-year perspective. And even if you take year till date for the last 9 months versus the previous 9 months, it's been a very strong performance. I will talk about the deal size, and then maybe Vijay Guntur can address the acquisition. Deal sizes, I think our pipeline has a mix of large deals and mid-sized deals. But if you see the quarter that went by, we had 8 large deals, but many mid-sized deals. A lot of digital transformation projects. Customers are awarding in smaller work packets, as and when they kind of formalize one of the requirements, they look at how can you set up smaller squads to kind of keep building the digital capability in their organization. The second aspect is we do see large deals. I mean, it's not like mega deals, like billion-dollar deals, but usually 100, 200, 300 million type of deals, which are outsourcing with end-to-end infrastructure application or product engineering, where you take over a certain product and continue to deliver more innovation. So there are deals of that nature as well. So it's a good mix of large deals and small deals. And Vijay, over to you on the skills on the STARSCEMA.
Thank you. Thank you, CVK. Thanks, Shivani, for the question. The deal that the acquisition that we announced is to leverage data engineering capabilities of STARSCEMA. They have deep front-end capabilities in consulting data engineering projects. Scalable opportunities, capabilities on the tail. However, HCL has the other way. We have a significant tail capability to scale up data engineering projects, but limited front end. So we expect a lot of synergy between these two to take up end-to-end programs, right from data consulting on to the entire data engineering and data quality assurance. So that's where we see this scale coming in. Second question you had was the people. We have over 200 people in STARSCEMA today, and a significant portion of that is with capabilities in the front-end consulting space.
Thank you, Vijay. Ladies and gentlemen, due to the paucity of time, we will have to end the Q&A session over here. If you have any more queries, please write into our communications department and we will get back to you. And that was our last question. Thank you so much for your questions.
Thank you everyone for your valuable time.